A golden spiral, elegant and perfect, overlays a chaotic EUR15 United States dollars minute chart. The numbers 0.618 and 0.786 glow softly on the screen. For generations, traders have been told these ratios are a secret code embedded in the market's DNA, a natural law governing financial price action. This is a carefully constructed deception. This failure is not an anomaly. It is the statistical norm. While millions of retail traders pray to the gods of the golden ratio, their accounts are systematically drained. On the other side of the trade, in cooled, silent data centers, institutional algorithms are not looking for magic. They are hunting for something else entirely. Something real. The algorithms see liquidity pools. They see order blocks. They see the raw mechanics of the market, stripped of all mysticism. The fatal mistake is believing Fibonacci levels have inherent power. They don't. Their power is unlocked only when they align with the true architecture of the market. An understanding that architecture is the first step to moving from gambler to quantitative analyst. To dismantle the myth, we must first prove it is a myth. Let's subject the standard Fibonacci strategy to a ruthless, data-driven stress test. The premise is simple. Draw a retracement from any significant swing high to swing low, and buy the 0.618 retracement, targeting the previous high. A common strategy taught across the internet. The simulation runs through 1,000 iterations. The parameters are generous. The logic is precisely what is taught in countless trading courses. The result is unsparing. A win rate of 49.2%. An equity curve that bleeds out slowly, then all at once. It is statistically no better than a coin flip. The conclusion is inescapable. Applied in isolation, the Fibonacci tool is an instrument of financial self-harm. This happens because the anchor points chosen by the discretionary trader are, from a data science perspective, meaningless. A swing low is not an event. A swing high is not a signal. They are merely transient ripples in a vast ocean of order flow. The market has no memory of these arbitrary points. It is not programmed to react to them, but it is programmed to react to something else. It is programmed to remember the precise moments where control violently shifted from buyers to sellers, or sellers to buyers. These moments leave a permanent scar on the price chart. This is not a ripple. This is an earthquake. Before we can even think about revealing how the Fibonacci tool becomes surgically precise in this new context, we must first understand why this structural break is the only event that truly matters. This event, a change of character, or CHOCH, is the first signal that the dominant market algorithm has changed its directive. In an uptrend, the algorithm's prime directive is to buy pullbacks and protect previous higher lows, using them as launchpads to attack higher prices. The moment that last higher low is violated, the directive has been broken. The buying algorithm has failed, or has been turned off. Now, a new directive can take over. Following a CHOCH, the market may enter a period of consolidation, or, more significantly, begin a new downtrend. This is confirmed when price creates a lower low, breaking the swing low that led to the change of character. This is a market structure break, or MSB. It is the official confirmation that the sellers are now in absolute control. These structural points are not subjective. They are binary, quantifiable events recorded on the ledger of the market. A high is either broken, or it is not. A low is either held, or it is not. This is the world of logic and data in which institutional systems operate. They do not care about how a trader feels about a price level. They care only about whether the structural integrity of the trend has been compromised. The entire narrative of price action hinges on these breaks. They are the chapter headings in the market's story. By anchoring our analysis to these objective events, we escape the sandbox of retail opinion and enter the arena of institutional execution. We have now identified the correct impulse leg to analyze the one that begins a new, confirmed trend. But even with the right impulse wave, a critical question remains. The break is the effect, but what was the cause? Where, precisely, did the cascade of sell orders originate that was powerful enough to shatter the trend? Because finding that source is the key to predicting where price will go next. The source of every powerful market structure break is a footprint left behind by institutional capital. This footprint is called an order block. Quantitatively, it is defined as the last opposing candlestick before the explosive move that broke structure. In a bearish break, it is the last up candle before the collapse. In a bullish break, it is the last down candle before the surge. This single candle is not just a candle, it is a crime scene. It represents a zone where large commercial and institutional players injected a massive volume of sell orders into the market. They absorbed all the remaining buy-side liquidity and then overwhelmed it, triggering a cascade of stop losses and initiating the new downtrend. Within this zone, a significant imbalance of orders was created. Many of their initial sell orders may not have been filled at the best price. The market, in its endless quest for efficiency, has a memory of this imbalance. It will often seek to return to this zone to mitigate those remaining orders, to allow the large players to add to their positions at a favorable price before continuing the newly established trend. This is the mechanical, logical reason for a retracement. It is not a mystical reversion to a golden mean. It is a liquidity-seeking algorithm at work. Now, we reintroduce the Fibonacci tool, not as a mystical predictor, but as a simple measuring device. Suddenly, the ratios have context. They are no longer random lines on a screen. The 61.8% to 78.6% retracement zone, often called the golden pocket, now highlights the most probable area for the market to retest the order block. It represents a deep enough pullback to be considered a premium price for sellers to re-engage, but not so deep as to invalidate the bearish structure. The logic is self-reinforcing. The structure defines the impulse, the order block defines the point of origin, and the Fibonacci tool maps the most probable path of retracement back to that origin. We have a high probability zone, but placing a blind limit order here is still incomplete. It is a static model. The final layer of our quantitative system requires dynamic, real-time confirmation that the institutional algorithms are, in fact, stepping in to defend this zone. This is where multi-timeframe analysis becomes our confirmation tool. The entire framework so far, the market structure break and the order block, was identified on a high time frame, such as the 4-hour or daily chart. This gives us our strategic, directional bias. We have identified a high probability zone of supply. Now, we must hunt for our entry with microscopic precision. We now drop to a low time frame, like the 5-minute or even the 1-minute chart. Our mission is to watch price action only when it enters our high time frame zone of interest. We are no longer concerned with the broader market. Our focus is narrowed to this specific battlefield. We are waiting for the price action on this low time frame to tell us that the sellers we identified on the high time frame are becoming active again. Inside the zone, price may initially continue its bullish retracement. This is noise. We ignore it. We are waiting for one specific event: a low time frame market structure break in the direction of our high time frame bias. We need to see the 5-minute chart, which was in a short-term uptrend, to reach our zone, break its own structure to the downside. This is the final piece of the puzzle. This is our confirmation. The high time frame analysis gave us the where. The low time frame break gives us the when. This signal indicates that sellers are now actively defending the high time frame order block, absorbing the pullback buyers, and are ready to resume the downtrend. This is a complete, logical, and systematic trading model. It moves beyond hope and magic. Every step is based on a quantifiable market event. 1. Identify the high time frame narrative. 2. Isolate the point of interest. 3. Define the retracement zone. 4. Wait for low time frame confirmation. The Fibonacci tool, once a symbol of retail deception, is transformed. It is demoted from a magical oracle to its rightful place: a simple, effective ruler. Its power was never in its ratios, but in the logic of its application. The market is not a code to be cracked, but a puzzle of cause and effect to be solved. By deconstructing the myth and rebuilding with logic, you replace gambling with a system of probabilities. This is the core philosophy at the Trade Logic Lab. For more deep dives into quantitative trading systems, subscribe and activate notifications.